Okay, part of the other for, pillar one is, do you have more time than you have money? You say, well, how much money do I need to retire? Depends upon your lifestyle. If you don't have probably, $2-3 million, because that's kind of the new norm. I mean, people say, well, you're a millionaire. $1 million nowadays doesn't go very far, especially if you plan to live maybe 20 years in retirement. So the key is how can you leverage that $1 million? How can you use it to give you a successful retirement in those years? And if you don't have $1 million, is there a way that you can maybe, gather those funds together? Maybe you have assets that that are maybe sitting where they've, been for a long time, whether it's real estate or maybe some bonds that you have, really not doing much. They have, a certain value. Maybe you should try to put together a plan where you liquidate some of that stuff, get the $1 million in place so that now you can use that asset and have it work for you. Because 20 years is a long time, and $1 million is not enough. You probably need at least 2 or 3 if you want to have a very nice retirement. So you need to find ways to put the assets together. And maybe you own a big house. Maybe if you realize that if you downsize, maybe there's a lot of equity there that you could use to improve your retirement. I mean, are you, like they say, you're house rich but retirement poor because you're putting all the money into the house because that's where you live? Well, you don't need maybe as much house as you did in earlier years. You maybe need a lot less. There's maybe an asset that you could use to improve your retirement. The key is to enjoy life, and to do that you do need significant funds. So I guess you have to answer that question yourself. Now we have plans where we can help almost any individual, starting at $50,000 all the way up to $2-3 million, of using our data and our system to generate a weekly income. And the more assets you have, the more flexibility you have to apply the data, and the better your result is going to be. You have a lot of more alternatives. You have ways to handle different conditions that occur in the stock market. So this is not a system or a method to get rich quick. We're not going to take your money and try to double it, in a month. What we want to do is we want you to apply the principles, okay, and the concepts that we put together and the data that we generate each day for you to make very good decisions to basically, our goal is to return 1% a week on your asset. And sure, so that's a tough goal. That's 50% a year. Is that possible? Absolutely, it's possible. And sure, we're going to have times when we don't get 1% a week, but we're going to have many times where we're going to be very successful. And even if you average the year with 30%, just think about that. That is significant, way above what the industry is doing or the marketplace is doing, and even these fancy hedge funds are doing, because they're all very, in an attempt to leverage a lot of things for you, and a lot of them sometimes lose a lot of money, and the key is they still get paid. We're results based. If we don't give you results, then we don't get paid. So the key is we're going to try to generate the best result for you, and you have to solve the problem of coming up with the money and putting it to work. And it's all up to you. It's also part of that mindset I talked about earlier. You have to decide that you want to be in control, and you're going to find ways to build that asset base so that you can, in fact, enjoy life in retirement.
How about a little bit about you, Ron? Can you tell them a little bit about your retirement, just briefly? 25 years ago, and you've been living off of this strategy for the entire time.
A little bit about myself. You say, is this all possible? Well, I'm kind of living proof. I started full-time in the stock and options market 25 years ago because I was offered an early retirement package, and my wife and I said, wow, Minnesota's cold. We were down in Marco Island, Florida on vacation. She says, well, this is where we should retire because of the weather. And we did that. We moved down to Marco Island because the process and the information of being able to do the type of thing we're doing is available wherever there's an internet connection. So you're not tied to any particular location in the country. You can do this any place. In fact, nowadays you can do it on a cruise ship. Anywhere you have an internet connection, you're able to monitor your positions and execute trades to basically perform what I've been doing for over 25 years. And the key is to continue the process, believe in the process, no matter what happens in the stock market. Because one of the things that we have done is we have built a system that gets you in equities that have staying power. Like I said earlier, we are not investing in high risk elements of the marketplace that tomorrow can go to zero. We're investing in strong strategic companies that have lots of value, and sure, their stock price is going to go up and down based on what the market does. We don't control that, but we have ways to generate income from that asset no matter what happens in the stock market. The key is we want to invest and show you how to invest in very good companies that have sticking power, they're going to be around, and they allow you to basically generate a return by owning that asset. So, and I've been through two big market, I'll call it drops. The dot-com bubble in 1999 to 2000, 2001. Remember, the NASDAQ was trading at 5,000. It went down below 1,000, okay, in 2000. So the key is how do you survive? You survive by owning significant, well-run companies that are going to be around, and all of the principles that I put in place basically kept me from investing in any of those dot-com bubbles companies that all burst. Because, for example, one of the fundamentals that we look at very carefully is revenue growth for any company. Well, a lot of these dot-com companies back then didn't have any revenue. It was all hype. It was about things that they said they were going to do. They really were not generating any revenue at all, and people jumped into them because it was the thing to do at that time. And that bubble just grew, and all at once, when it burst, it all collapsed. All of those companies were gone, 90% of them. There were a few that stuck around, but most of them collapsed because there was nothing that they were doing that was sustainable. It was all hype. So the key is the trading by the numbers, trading by the data, making decisions based on data that that is being provided daily because of all the data processing and analysis that takes place is a key factor in being successful. So I've been able to survive or go through the dot-com bubble, and now in the housing bubble in 2007, 8, and 9 when we had the collapse there. Again, why did that collapse? Because banks and institutions took a lot of risk. They sold mortgages to people that couldn't afford the mortgage. They bought houses that were twice as expensive. In other words, the real estate values were double. They got in, put on a big mortgage, and then when the real estate market collapsed, they walked away. So all of the banks and institutions that had those mortgages are at risk. Okay, so the key is we're not investing in those type of vehicles. We're investing in solid companies that we know are going to be around. And that's key to survival. We'll call it survival. And you're worried sometimes of the fear of investing in things. You need to put that fear aside and look at the underlying fundamentals of the companies that you're investing in and the opportunities being presented to basically have that investment work for you and you not work for it. It's working for you on a weekly basis, and that's the key to success. I've done it for 25 years and I'm still doing it. In fact, my children are doing it. I've taught my children to do it, and they're very successful at it. So, and they're not even retired. They're doing it to help pay for their children's college educations because those costs have gone up significantly. So the key is there are ways to generate a significant return with the process and data being offered at Wall Street Minimum.